All right, everybody, if we're invested in the stock market, it's important to at least take into account what some of the best investors of our generation are thinking about and how they're managing their portfolios and what they're doing in the markets. That doesn't mean we should copy them. Some are bears, some are bulls. They all have different strategies. They don't all work for us. We have to do what works for us. But Stanley Druckenmiller, one of the best investors you may have never heard of, has like a 30-year track record of returning 30% or more and never having a down year. He is undoubtedly one of the best investors of the last 50, 100 years, whatever. He just came out. He was interviewed at this NBIM Annual Investment Conference 2023. It was at the end of April. We're at the beginning of May. And he shared some things that really explain how I'm feeling about the market, admitting I'm much more inexperienced and don't have anything like the track record of Druckenmiller, but he vocalizes and verbalizes a lot of the uncomfort and unease that I have in the market. Granted, if you're a long-term investor and you just want to work and not think about the market, then as always, the best thing to do is just dollar cost average into your retirement fund, into the S&P 500, whatever, set it, forget it. In 30 years, you'll be fine. I like the challenge of investing a little bit more actively. Generally, I want to be a long-term investor, not have a lot of turnover, but I've had a ton of turnover recently and I don't like it. But I just feel like the market is not in touch with reality right now. Anyways, I'm going to play this video. I'm going to stop it for some commentary. And then at the end, I'll show a couple of examples of some of the stocks and types of things that Druckenmiller talks about in this video so that you could see some of the examples he talks about.
Stan, we have been discussing in Oslo inflation, energy, AI, chips, geopolitics, and so on. So when you put your investing hat on, what's at the top of your mind?
The top of my mind, first of all, it's good to see you, Nikolai. I would guess the top of my mind is just how uncertain for me trying to analyze the environment is going forward. I've been doing this for 45 years. I've studied a lot of economic history, but I've never had a situation where you had free money for 11 years, a very broad asset bubble, followed by jacking up rates 500 basis points in 12 months. So for someone like me who likes to look at history and come up with potential scenarios, this is a particularly difficult period. 2 years ago wasn't so difficult when you had 2 years at 15 basis points and money's probably growing at 30. It didn't take a genius to figure out that was a good risk reward. These days, things are a lot more complicated, but you just mentioned about everything on our mind. Generative AI, inflation is on our mind, asset bubbles, currencies, all the stuff we usually think about.
So he talked about it right there, right? Like this is one of the more challenging environments that he's been in. The Fed has increased rates faster than at any time in history before. And to him, it's unclear still on what impact that's actually going to have on the market and different types of markets and different stocks specifically long term, because it's happened so fast. And he's one of the best performing, most experienced investors in the world. And he has really no idea what to do. And he also said in 2020, 2021, when money was super easy and the Fed was just injecting money into the economy, it was super easy to be fully invested and long stocks, right? And I think a lot of us, myself included, just did that. Our stocks went up and we all thought we were geniuses, right? Well, maybe it wasn't that we were geniuses. We just kind of got lucky and invested in stocks at the right time when basically everything was going our way. And I made that mistake. I didn't think a lot about valuation and fundamentals of stocks, or I did, but I didn't maybe know what I was doing and what I was talking about. And turns out a lot of the stocks that I was invested in kind of like the COVID bubble are still down 70%, 80%, whatever. And fortunately, I got out of a lot of those. And as I've shared on my channel, my portfolio has been all over the place. But that's really what I'm trying to do is like figure out, how much of it was just luck in 2020, 2021. And then what is the best way to actually invest moving forward in an environment where rates are higher and not every company that comes out and says one thing is going to just continuously go higher, right? That's not how investing
So how do you
works.
navigate it?
Well, luckily I don't have any clients, so I don't have. I don't.
Well,
I don't have to-
I have one client, and it's pretty big.
It's really big. I don't have to. I don't feel performance pressure. So historically, I deal in 5 or 6 asset buckets. Tends to keep me out of trouble in terms of playing in an area where I shouldn't be playing at a particular time. And I think it's one of the most important things to do is not to play when you don't see a fat pitch. I don't see a fat pitch in fixed income. It's extremely complicated because I'm in the hard landing camp, probably sometime later this year. But again, this is so complicated. I'm not willing to place a big bet. And even if I believe in a hard landing, which I do, what do you do with 2-year treasuries at sub 4% with Fed funds at 5.25%? I better be right on my hard landing if I want to own fixed income. And then in the longer end, historically, this is easy. If I believe we're hard landing, I'm supposed to own bonds, but they're not exactly a screaming bargain. 10 years at 3.5 in the U.S., particularly with a Fed that has certainly shown some mettle in the last year, but historically, I wouldn't say Jerome Powell is a profile in courage. So if we get into a hard landing and he moves aggressively, I could see bonds and inflation coming back with a vigor from what I expect to be a lower level than right now. I will say that the response to Silicon Valley unnerved me a little because in 4 days, they printed enough money that basically wiped out the entire reduction of the balance sheet they had done for 5 or 6 months. So if I'm trying to look ahead and anticipate, I don't have a lot of faith in these guys. Should we get into a hard landing, that they're going to hold the line and not do something maybe worse than Arthur Burns.
So what he's talking about here is, it sounds like what he thinks is going to happen is a hard landing, meaning a bad recession. And it sounds like that's kind of what he thinks needs to happen to really get a handle on inflation. And that's bad for people's jobs. That's bad for the economy over the short term. But over the long term, in my understanding, one of the worst things that can happen to an economy is inflation that just sticks around, and kind of like what happened in the 80s where the Fed raised rates, but then lowered rates too quick and inflation came back and then the market dropped even more. Some type of hyperinflation type scenario. It feels like to me, that's what Druckenmiller is kind of worried about. He's worried that if we start to see a weakening economy, which if you watch the news, we are, that the Fed may actually back off too early and start lowering rates too early, which it feels like that's what kind of the market thinks is going to happen, because until today is May 2nd, we've seen the market rally on bad economic news. Why would the market rally on bad economic news? Because they think that means the Fed is going to either, lower rates quicker or not raise rates as much. Those sound like the same thing, but they're a little bit different. And generally, when that happens, when the Fed lowers rates, the market rallies in the future from there. Where I think the disconnect is, and it sounds like Druckenmiller thinks the disconnect is what has to happen to the market to get to a point while the economy is weakening to where it does rally as the Fed lowers rates, because that's good, good for stocks over the long term. I don't think the market has dropped enough. And the reason I think this is because the PE ratio of the S&P 500 and of the NASDAQ is at about its 20-year average right now. During the 20-year average, we were in an expanding economy. We were in a basically zero interest rate environment. And now rates are, going to be between 4 and 5% for a while. And so the stocks should not trade, in my opinion, at the same multiple as they did when rates were near zero and the economy was expanding. The mistake that I'm probably making is I'm too active. And as Druckenmiller says, he doesn't take a swing unless there's a super fat pitch. And even though he thinks the economy, we're in for a hard landing and essentially bonds would be the place where you want to be invested long term if that happens. He thinks rates, sounds like, could go higher in the meantime, and then if you're in bonds at the wrong time, you can lose money in that. So that's kind of like a timing thing. But it sounds like where he feels, or what he thinks is going to happen, is the economy's we're going to have a hard landing. That's going to hurt the stock market, and eventually rates are going to come down. His problem is he doesn't know what's going to happen and when it's going to happen and the timing of it. So he doesn't see a fat pitch.
And where does it leave equities?
I think equities are really complicated. I think within the equity market, if you put a gun to my head, I'd be short the economy to the extent I should. Something pure like Russell 2000. Obviously, I don't want to go into individual short names, but names like that old economy, economically sensitive stuff. But let's just say we're going to have a hard landing and a bad recession in the U.S. What does that mean for NVIDIA? I don't know. I mean, oils and chemicals went up in 73 and 74. Staples have gone up in bad recessions in the U.S. historically. What do I do with a company if you have a bad recession in the U.S., but it's growing wildly throughout that period because we have an arms race going on in its space? It's not clear to me it goes down. So I think the equities are complicated.
But just to come back to this, so you say you haven't seen it as problematic for 45 years and it's really complicated and so on. So what do you do then? You sit in cash or?
Oh no, I'm too. I'd like to say I sit in cash, but I'm too much of a junkie. I'm always doing something. I'd say our equities were about 3% net short, which is nothing. But again, there's always equities we like versus other equities. Our fixed income position is minimal, except in JGBs, where I don't know whether I'm going to get paid or not, but I think the risk reward is ridiculous. It reminds me just a little of the 2 years ago. They have an inflation problem, but again, I'm dealing on government action. So it's not cash. We got stuff going on, but I'd say my P&L doesn't move generally more than 30 or 40 basis points a day. That's how buttoned down I have what I'll call our matrix here. Our matrix being the buckets I talked about and the investment within those buckets.
Yeah.
So I feel like that encapsulates like a lot of the way that I am, and maybe my problem right now, right, is like he's like, I'm too much of a junkie. I'm always doing something. I've been active too recently, right? And it's not because I feel like I'm addicted to trading in the market. It's just I am a long-term bull. I came up basically from the Motley Fool. I freelanced for them and sort of learned investing the Motley Fool way. If you're watching this, you're probably familiar with that. It's very much like buy and hold and don't sell or try not to sell. I think that is the right thing to do most times. I just think right now there's a disconnect in the market and what the market is expecting and what the Fed has said they're going to do and it's going to have to do in order to keep inflation down. And I think that when the market accepts that and believes that and realizes that, which could come tomorrow, or I could be wrong, then we're going to see, a 5 to 15% correction in the market. And I'm investing amount of money where I want to try to avoid that. Right. And I have the time right now that I'm spending on this so I can pay attention to it. A lot of people can't, and they're working, and I get that. So anyways, watch the rest of this video. If you just Google Stan Druckenmiller NBIM annual conference, you'll find it.